So this brings us to the net policy reserves of life insurance companies. Okay, when people have certain life insurance types of life insurance policies, they are permitted to borrow, to take an instant loan, okay, against these whole life insurance policies, okay, up to a certain percentage. And Rothbard then included those net policy reserves, the extent to which people could withdraw money from their insurance policies, okay, on demand. Now, that's controversial. I don't believe it belongs in the money supply. And even when Murray Rothbard and I in the 1980s came up with what we call the true money supply, we cooperated in coming up with a sort of an Austrian definition of the money supply, we left out net policy reserves. Okay. In any case, though, this is not Rothbard trying to contrive some sort of a broader measure of the money supply so as to make the 1920s appear as if it was more inflationary than it really was. Because if you look back in the 1960s and 70s and look at mainstream Keynesian textbooks, okay, on money and banking, you'll find that many of the writers included these as part of the money supply or as a very liquid asset that was very, very nearly money. For example, a book by Walter Haynes characterized insurance companies as savings institutions, okay, and noted that these savings can be withdrawn at any time, simply by allowing the policy to lapse, a feature that marks them as a near money, okay, on a par with savings accounts. So here's one writer that put them on a par with savings accounts. M.L. Burstein maintained that the cash value of a life insurance policy offered, quote, ready convertibility into cash, was almost as liquid as a mattress full of currency. So he's saying it's almost like currency, because you can immediately withdraw it, and satisfied the precautionary motive for holding liquid assets no less than savings and loan accounts and savings bonds. Albert Hart and Peter Kennan included the net cash values of life insurance in the broadest class of financial assets possessing the attribute of moneyness. Okay, so the Keynesians approach their definition of the money supply a little differently than the Austrians. They believe that liquidity determines if something is part of the money supply, how easy it is to get cash for it. And so in the broadest aggregate, or monetary aggregate, as I said, Hart and Kennan include the net cash values of life insurance. Finally, Thomas Cargill, who I believe is a monetarist, ranked these net cash values or net surrender values of life insurance policies. He ranked them on a liquidity spectrum, immediately below certificates of deposit, which are included in the current M3 definition of the money supply. So whether Rothbard was right or wrong in including these, he certainly was in good company. There were other economists with other definitions of the money supply that were including the net cash reserves of life insurance policies in their definitions of money. All right. Well, I went on and I took out these net cash reserves, okay, to see how it would affect the how inflationary the 1920s were, and that is the rate at which the money supply increased. And what we find is the following. Yeah, I'll fix that by doing the lights. Right here.
That's it.
Here we go. Good. Very good. Is that good? No, I'm going to write something. Don't worry. I just turned the thing over. What I wanted to, okay, so here's what I found when I recalculated Rothbard's money supply, okay, leaving out net cash, the net cash value of life insurance policies. Okay, so let's call it the RM for Rothbard's money supply. And the percent increase in Rothbard's money supply. Did I touch something that caused it to? Yep. Yep, sorry. Okay. Right. It turns out that from 1921 to 1928, according to Rothbard, his money supply increased by 61%. Now, on a yearly basis, that's 8.1% per year. Okay. Now, recalculating Rothbard's money supply and leaving out the net policy reserves, I found that instead of 61%, the overall increase was 55%, which yields a 7.3% per year change in the money supply. Still a tremendous rate of inflation of the money supply. Okay, it reduces it marginally. Okay, it doesn't. That 7.3% can just as easily set off the Austrian business cycle theory, since it's flowing through the credit markets as the banks inject new money into the economy. Okay, just as easily as an 8.1%. Okay, I think it's a minimal difference. Okay. Now, Rothbard goes on, Timberlake goes on to criticize Rothbard for ignorance of the flawed institutional framework within which the gold standard and the central bank generated money, okay, and also mismeasurement of the central bank's monetary data. In fact, Rothbard was quite aware that the U.S. monetary regime of the 1920s and 1930s was not a genuine gold standard. Okay, that in fact it was a watered-down version of the gold standard. It was what we might call a form of the gold exchange standard. Okay, it was in fact a hybrid system in which it wasn't merely market forces. Okay, that is the inflow of gold to and from abroad and through the balance of payments to abroad that determined the money supply. Okay, but the Fed in fact possessed substantial power to manipulate the money supply regardless of what was happening to the stock of gold in the economy. Okay, by pyramiding paper reserves, okay, both notes and deposits, on top of the stock of gold reserves. So in fact, Rothbard went much further than Timberlake in completely separating those factors affecting the money supply that were subject to the Fed control and those factors that were not subject to the Fed control. For example, changes in the gold stock. Okay? So now what Timberlake does is the following. He says, well, the Fed was actually deflationary during the 1920s. The Fed was attempting to be deflationary during the 1920s. And he arrives at this by the following. He says, look, we have the monetary base, which under the gold standard includes the amount of currency in circulation, okay, plus reserves, okay, which include gold as well as Fed notes. Okay, banks hold both gold and Fed notes as reserves. Okay, so that's known as the monetary base. And what Timberlake then does is to say, well, the Fed does not control the gold supply. Okay, the gold supply is determined by the balance of payments, which is determined by market forces. So he subtracts from this the gold stock, and he calls. Actually, I should do that on the next line. He calls this the net Fed. What the Fed can control. The Fed can control. Let me just force that out. The Fed can control currency plus reserves minus the gold stock. So it can control the paper currency in circulation and the paper reserves that banks hold. Okay, can't control gold reserves because they are determined, as I said, by the balance of payments. Now he says, if we look at what he calls the net Fed, okay, what the part of the money supply or the base of the money supply that it can control, he says that in fact this aggregate from 1921 to 1929 fell by 8% per year. So not only was the 1920s not an inflationary decade, now this is not the money supply. The money supply was going up, but not according to the monetarists, but not at a very great rate, not at the rate that Rothbard had claimed. But not only was it not an inflationary decade, the Fed itself was trying to deflate the money supply, according to Timberlake. Okay, it was only the uncontrolled gold stock that continued to cause the money supply to increase. Okay, because gold was flowing into the U.S. Well, it is true that the gold stock is uncontrolled by the Fed, but Rothbard points out that there are other factors that are uncontrolled by the Fed. For example, the currency in circulation isn't controlled by the Fed. People can take currency in circulation and that they're holding and deposit in the banks, and that becomes part of bank reserves, which then would cause a multiple increase in checking account money. So whenever anyone puts a dollar, let's say today, into the banking system, you cause at the limit an increase in checking account money by $10. On the other hand, if at Christmas you want more cash because you're going to buy small gifts and so on, and you withdraw, and this does happen, by the way, in a very large way during the Christmas season. If you withdraw, $1,000 from your checking account, that would cause a decrease, all other things equal, in the money supply by $10,000. Okay? So, currency, which is the currency in circulation, is controlled by the not by the Fed, but by the public. All right. So he points out that currency in circulation, or I pointed out that currency in circulation, it really is improperly in Timberlake's net Fed aggregate. Okay, because it's not controlled by the Fed; it's controlled by the banking public. All right. That's not all. Okay. Under the prevailing policy regime of the 1920s, the banks themselves could reduce the amount of bank reserves, and that's the quantity of money in existence, by deliberately reducing their indebtedness to the Fed. In other words, if they wanted to borrow from the Fed kept the discount rate, the rate at which it loans to banks, at a very low level, a level that was below the market level. So when banks came and borrowed, okay, at that rate, they could then lend at a higher rate, and that would expand the money supply. So the Fed could control that. By raising the interest rate, the Fed could restrict borrowing from itself, and therefore could control these borrowed reserves and the increase in the money supply that resulted from them. However, on the other hand, the banks themselves had the right to pay back these loans at any time, or let them lapse, not renew them. And when they paid back the loans, that decreased the money supply. Now, the paying back of the loans, according to Rothbard, and I think he's correct here, is controlled not by the Fed, but by the banks. So according to Rothbard, what we're going to call the controlled factors, okay, the Fed's controlled reserves, okay, let's call them the Fed's controlled reserves. This is Rothbard's equation. You have to subtract from the monetary base, so let's start the monetary base, which is currency plus reserves, not only the gold stock, because that's not controlled by the Fed. You also have to control, subtract currency, because that's not controlled by the Fed. It's a little straighter here. And finally, you have to control or subtract net bills repaid. Okay. So when banks pay back their loans from the Fed, that reduces the amount of reserves they hold, and that reduces the money supply. So the Fed controls then only a portion of the reserves of the banks. Okay, that portion that they can inject into the system through open market operations by going out and buying, by creating money and buying various government securities and so on. So if we readjust the factors that can be controlled by the Fed, okay, we find, according to Rothbard, the following.